All right, good morning, everyone. If anyone is overseas, as I know Stefan is, good afternoon, good evening. My name is Tim Powell. I'm the president of the Minerals and Royalties Authority, and I'm really excited for this discussion. I run an advisory firm that specializes in minerals, and because of the dual strategy of non-op and minerals together, do get quite a bit of exposure to the non-op space as well. And I have hundreds and hundreds of conversations a year, meetings. I host a dinner every 45 days or so with mineral CEOs, and I do a lot of content. And so in the shadows of, connecting the dots of all these conversations, I try to do webinars every once in a while on things that are relevant. And what's relevant right now is ABS, and can it be done in minerals, non-op in minerals? How does it compare to work interest, scale? We're gonna tackle all these things. There's a lot of chatter about it and a lot of interest. And so I want to bring this to my audience. And I was in Vegas at WAPT having dinner with Victor. And I said, "Hey, my name's Tim. Nice to meet you. What are you doing?" He's like, "I'm head of securitizations for Donovan Ventures." I was like, "Well, I've been wanting to do this webinar for a while." So that was the birth of it. And we put the panelists together and really looking forward to a good conversation. So I hope everyone enjoys. Please be as interactive as possible. If you want to follow up with any of the panelists specifically for your own direct business needs and ventures, please either reach out to me or reach out to them directly, and we can get you in touch. But without further ado, let's do a round the horn introduction. Gentlemen, just slight background, brief background on yourselves and the relevancy to securitization and how it ties into what we're going to talk today, and then we'll kick it off with the questions. So, Patrick, if you want to kick us off.
Sure. Background is most of my career was in a hedge fund, doing some energy stuff there, mostly in alternative space. Left there to start a royalty focused, kind of PDP yield focused company. And as we were exiting that, we started looking a little bit into, how do we expand into more, PDP? How do you separate kind of exploration from production? What different investors like different, different asset class and has different risk appetite. We'd started doing some raising money to do PDP yield focused investments. Obviously, securitization kind of birthed around the same time. Makes sense for us in what we're doing to also expand into securitization. We have investors that basically would buy into equity of securitizations versus bringing the senior note part of it.
Excellent. Yeah, and just for reference, everyone, that's Patrick Conway, President and CEO of DAR Energy. Just if you guys can mention your full name, title, and company, just so people can put a face to a name. Victor.
Yeah, thanks. Good morning, all. My name is Victor Mendoza. I'm the head of oil and gas securitizations for Donovan Ventures. We're a one-stop shop for ABS transactions, from structuring and execution to distribution and placement. We've closed over $500 million of ABS transactions in the first half of this year, and we're on track for another $1 billion in the second half of 2022. We're very happy to be on this panel. We're keenly focused on expanding the ABS product into the royalty and override space, and we're excited for the opportunity to hopefully partner with some folks on this call.
Excellent. Rahul?
Hey, I'm Rahul Vashi. I'm a partner at Kirkland & Ellis in Houston. Focus my career on oil and gas transactions, M&A generally, including these working interest in minerals securitization transactions. Recently worked with Victor to close an unconventional shale ABS just a few months ago.
Excellent. Stefan?
Yes, good morning, everyone. My name is Stefan Lamoni. I'm the CEO of SLU Enterprise. My background is I've been in asset management for 25 years. I was a chief investment officer of Amundi, which is the largest asset manager in Europe with over 1 trillion under management. It's where I became familiar with the contradiction of investing large amount of money. If you have 1 trillion, you cannot invest less than 1 billion. Otherwise, you have like more than 1,000 lines in your portfolio. So that's the big contradiction. because then you need to be able to buy assets or direct assets, and you're not a specialist because you have to spread your money towards lots of different sectors. So it's where securitization plays a role, and especially if it goes with a rating, and then it enables you to invest in sectors without really being specialist. Then I moved to Elliott Advisors, the hedge fund, where we've actually deployed disruptive technologies, and later created a company called BIM, which is dedicated to investigating how oil and gas could be produced in a cleaner way. So we get $120 million as a startup company from pension funds in the UK. And it was an interesting 5 years in the Permian Basin, try to re-engineer, retro-engineer, retrofit some equipment to make it cleaner. And then this is what led to the creation of SLU Enterprise, which is doing exactly the same thing, direct investment from large pension funds into securities, which are actually securities in LLCs for the new developments of oil and gas properties.
Excellent. And then Greg.
This is Greg Kavance. I'm the managing director at Fitch Ratings. I cover a group called the Global Cross Sector. It's under the structured finance area, and we look at alternative assets. Been working in securitization for more than 25 years. Majority of my experience over the first 20 was probably in emerging markets. In fact, we did royalty deals in Argentina and Brazil and offshore deals all over Latin America, the North Sea, Southeast Asia. I don't know, 5 or 6 years ago, we just saw the way securitization could actually work within the U.S. market and the nature of it, and why this type of funding might be a better solution, permanent capital for various companies as opposed to maybe RBLs. So we've rated probably upwards of 20 transactions in the U.S. and several offshore different types of platforms and other export receivable deals all in the kind of oil and gas space.
Fantastic. All right. Well, I'd like, Greg, we'll keep it with you. I'd like you to set the table here. I think when you're looking at doing a securitization, the risks that are analyzed and goes into the rating, and I think why I wanted you have Fitch on the call is to see how you view the ABS world and what gets considered, so that the issuers out there can that are building the assets can try to put together the right formula. So kind of 3 buckets. How do you view the oil and gas space? And then we'll break down the risks within those buckets, Greg. And then I think each of the panels will be able to jump in at various points as we walk through that. So Greg, over to you.
Okay. And I think we probably, I would say, separate these into different areas. Operating working interest deals where it's a single operator, non-operating working interest, or royalties. And I think the order of kind of along the spectrum, the operating has the most kind of operating risk to it versus non-op, versus royalties, probably the most passive. Passive in the sense that you're not operating and you're also not responsible for the expenses. So I think that's also an important area. I think when we look at
so we'll stay there, and then we'll go on to the other categories. So in the category of operating risk, is it merely a function of control? So the minerals and non-op space here, we'll just look at it. And that's one of the major things, right? You don't have control of your destiny. Then there's also the quality of the operator, the financial health, the track record. I don't know if these investors are generalists, but do you need to show that it's ExxonMobil and it's a brand name? Stefan, that's something you've contemplated quite a bit at SLU, is having brand name operators involved in the securitization to give comfort to generalists. So I'll throw that out to the panel and let you guys jump it around. How do you categorize operating risk, and let's break it down at its various levels?
I can jump in just to finish my point. We're assuming the majority of these issuers, when you look at them on a comp basis across, say, our corporate world, the size is really impacts what a corporate rating might do. So we're making an assumption if we don't rate the entity underlying, we're making an assumption it's generally in the B category. And there's a lot of operating risk attached to that. So we can't really get ratings out of, say, the triple B rating, unless you're talking about, and we've talked about this a bit with some of the brand names, the double B, triple B type entities that might want to do this. So I think that's important. We can rate these transactions up to single A, but that's really when we have a very diverse portfolio with not a lot of operating risk. And that's more on the latter categories I was speaking of. The other point when we built this framework, I mean, for better or for worse, there's been a lot of bankruptcies in the oil and gas industry just due to the cyclicality. And just watching how they play out and watching how production is really not impacted much. Maybe you're changing the C-suite, the management, but the operators on the ground are the same people. They have the same Chevron tag or whatever tag they might have from whoever purchased that. So we see that transition. From a legal standpoint, the real property interest is a very important aspect in that there's enough kind of legal precedence, as we've seen through bankruptcies, how that ownership can change places. We can talk a bit about control, but I'll let others jump in and we can talk through the rest.
Yeah, let me just step in from the investor side. Obviously, for the operated deals, like Greg mentioned, there's, the analysis, the due diligence is based off of a single operator. For the transactions we've printed and we've seen in the market, these are either kind of small caps or private companies that are unrated, right? So the investors have gotten comfortable with a single operator that doesn't have a rating. When we discuss royalty and override transactions with them, of course, they want to know, what percentage is operated by, what caliber of operator. But I think, when you look at, how you've gotten comfortable with a single operator, I think from an investor standpoint, an override would be less risky in a lot of ways. It would make a lot more sense. And like Greg mentioned, you're also obviously not worried about, the OpEx as much. So I think, that being said, it will matter if you have, the majors operating all of your PDP, but obviously, they're, investment grade themselves. So obviously, the ABS is investment grade. That's what we have to aim for. But the operator, I think from a royalty and override perspective is important. You just have to understand it. And I think investors are comfortable with pretty much anyone if they can, do the due diligence on those operators themselves.
I agree with your point, Victor, about diversification for investors. It's actually key. The way we dealt with this operating risk is that we went, when we started creating the SLU enterprise framework, we spoke to Ryder Scott and we told them, would you like to rate these securities? And they were a bit afraid in the beginning because it seemed to be a bit different from their commercial business of assessing reserves. But they came up with a very smart system with ranking A, B, C for commerciality and A, B, C for the quality of reserves. And of course, the development plan, which is actually put together by the operating company, is assessed from a risk point of view. The well control, everything which is actually has been achieved by the operating company is taken into account by Ryder Scott. So they come up with a very clear framework of rating, which we believe is completely replacing the need for data room and due diligence for investors. So the securities are rated. And of course, to come back to your point, Victor, about diversification, it's all very nice to diversify in 10 different securities, but if you have to due diligence and data room 10 different opportunities, it's too much work. It's where the rating comes, we believe, as a very handy point, very, very necessary parameter.
So let's go to the next bucket, volumetric risk. And Greg, do you want to kick us off again, and then we'll go around the horn?
Yeah, I think just to separate things, and I think one of the questions you were asking to me was diversification helps on that front. So the more concentrated we are among operator, basin, wells, we're going to have a higher stress on the volumetric risk. I think we kind of separate things into different factors. Anything younger than 6 months, we would like to see more seasoning than that. We're probably not able to do a good job in that front. So we're very stressful if that's the case. Anything after 6 months, but up to 2 years, we're probably a little, less stressful, and everything after 2 years, we feel like the track record has shown itself, and it's probably more the sweet spot for what we're doing in the securitization side. There's a question also on just child parent, but I'll jump into that later.
Yeah, does anyone want to jump into? I think I'd like to address that under volumetric risk, because I think does Fitch drive down to that level of detail?
I think we do, but honestly, the low hanging fruit and the initial deals, just due to the vintage of the period of time, you don't have that activity to where that was going to impact a volumetric risk. It's not to say it wasn't involved in some of the deals. I think going forward, that becomes much more of a factor as prices are up and, people can start drilling more economically in a variety of different places. We look at continuous acreage and just, how much control, how many players are within that, that basin. I think that does drive part of that. We also rely a lot on, Ryder Scotts of the world and others to kind of talk through some of those issues. Diversification, once again, kind of comes into play and kind of helps on a lot of those.
I think,
sure, Patrick.
On the parent-child issue, I think you'll see, and Greg's kind of pointing, you're going to see that be a bigger risk now with higher prices, right? So, in places where there wasn't a lot of development, that wasn't that big of a deal. I think you're also seeing now where, an operator may come in and say, hey, look, I'm going to put, these wellbores into a securitization vehicle, and I'm going to go develop nearby. Obviously, those investors don't want you to be stealing, volumes, right? So, you're probably going to look at offsets. You're going to look at, having some sort of relationship between the two entities. So there's not a conflict between, the operators on both sides of that transaction.
Yeah. No, that's exactly right. I think as we move more into, unconventional basins, obviously, the declines are steeper. I think Fitch has done a great job, evaluating conventional assets with long histories, and we're kind of transitioning into more, unconventional transactions, shorter, more newer vintages. So on our side, from the due diligence standpoint, we've actually, invested and focused on software and analytics to evaluate the predictability of PDP and help Fitch kind of have a, third set of eyes on what the, expected production should look like, and quantify that with a standard deviation of certainty. And we also keep track of, through this kind of platform that we have, of drilling permits, rig activity, proximity to the securitized wells that are being evaluated, back testing on, parent-child issues. What was the impact on the volume of those wells when there were wells drilled adjacent or offset to the historical wells that we have, right? So that's, it's a very valid point. It's a valid point from both Fitch and from investors, right? I mean, obviously, it's a very structured product, and you're relying on the cash flow, which is relying on the volumetric, right? So we try to quantify that into a percentage of potential risking that we should evaluate in the package as a whole, right? And as Greg mentioned, if we're talking about hundreds and thousands of wells, even if you do have some development going on around you, around, certain, acreage, you might have a lot of value on, stuff that is, just PDP blowdown that is not, being drilled around, right? So we definitely focus on that. I think it's a valid point from both parties. And we, try to make, the best that we can from what we have to offer, issuers into, structuring and quantifying those risks.
And Tim, to come back on these parent-child issues and the different choices that are actually the operating company can decide to have 12 wells or 8 wells or 6 wells per batch. And that is making a very big difference from a Ryder Scott rating point of view, because along with the quality and the commerciality, there's also the volume available that can be produced. So it's not reserves, but it's actually recoverable volume. And you could actually drill more wells, so you have more risk of parent-child issues. Therefore, you'll have a larger volume, but with a lower commerciality, because your EUR per well is going to be lower. So that is all taken into account in the what's called rating for the SL super locations. They've already done that exercise for a bit less than a dozen super locations for 7 large E&Ps in the Permian. And discussions about rating are key to the development plan. Okay, if you're going to give me a B rating with a lower volume, then I'd rather maybe have a higher volume but at a C rating. And so all the discussions are strategic for the development plan. And Ryder Scott has had a lot of experience at looking at the history of this parent-child issue per operating company, because they're measuring that for the reserve assessment anyway.
So question, we're getting into the nitty gritty from an investment product standpoint that's brought to the investor. How is it really delineating all these details to help the rating get to the end point, and then the rating is really the main differentiator for the investor? Or are they getting in the weeds as well on understanding all these? I'm just trying to, the point I'm kind of getting at is generalists, and how specialized you need to be to enter this space from the buy side.
Yeah, I mean, quickly, just from an investor viewpoint, right? There's definitely a strong reliance on the Fitch rating, right? But that doesn't mean that they're not going to do their own due diligence, right? So I think, a lot of the larger guys are sophisticated. They have oil and gas teams, so they will dig down into, LOS databases, historical reports to do their own evaluation. And, obviously in support with Fitch's rating, they'll come up with what they think the rating should be, or an advanced, proper advanced rate should be. So I think it's a mix. I guess in short, they would never do a deal that's not investment grade and that doesn't have an investment grade from Fitch, right? Or from, other firms. But they still will do the due diligence. And I think the more sophisticated they are, the deeper they go into the weeds, and they will use some of the analysis that we provide for that. And they, have a long list of due diligence questions that will help out. And Fitch also will talk to the investors on their side, right? So they'll answer questions, due diligence questions for them as well. I'll pass it on to Greg on that point.
Yeah, I mean, a lot of the transactions have been private. But typically on many other markets, we do have a full kind of report that kind of goes through our analysis. In lieu of that, we basically do webinars/investor calls. But all the investors are, anyone who's participating, or at least the most successful investors and even arrangers, are teaming up with their oil and gas and their ABS teams to kind of overlay the industry expertise. And many of the big investors, have fairly deep experience in that. So we're a complementary/supplementary form for the analysis. And I think a lot of these entities are doing that on their own. And especially if you're looking at kind of triple B, single A, it's not really going to the retail. It's more to an institutional investor base that has the expertise to kind of deal with it.
On the back of that point, let's talk about collaboration. Patrick, when we prepped for this, you talked about on the hedging side, which we'll get to in a bit, collaboration between the buyer and the seller is paramount to get the optimal hedging strategy. Is there really this collaborative effort from the investors, from the buyer, the seller, just everyone involved to get the product to the best shape for where it's a win-win for everyone? I think why this is such a relationship-driven business is you do deals with someone once, and you kind of enjoy that experience. Due diligence is not as painful as it is with others, and you want to repeat that. And so is there a sense of that trying to make it a win-win for everyone and really working from all sides versus just, you kind of get the asset and just let the advisors run and just take it to the investors? Some insight on that, and then we'll move on to the next category.
Yeah. I think the first thing I would say is, I'm not sure anybody on the panel would suggest using securitization as a acquisition tool. So, to use this between buyer and seller, I think, the advantage, I think, for a seller is someone who says, hey, listen, I have a PDP heavy asset. I want to keep the development. I just want to spin off the PDP or, exit on this. If they don't want to do a securitization themselves, which I think we'll get into later about, is there a secondary market for that type of vehicle? But if they don't really want to do it, but they want to get the value for it, what we've kind of talked to people in the markets, especially the sellers, is saying, hey, look, like this is more of a collaborative process. So if you want, someone like Adara to come in and buy this and securitize it, and you want to get the value for it, but you don't want to be the end holder for it, there needs to be more of a collaborative process. This is not just a buy-sell type relationship. There's a lot of, it's obviously a PDP asset, right? So it's fully contingent on commodity prices. As everyone knows, prices have been very volatile the last couple of years. So, either that's a floating price concept that, the price kind of goes between a floor and a basement, as we, before you get to final execution, or, hey, seller, come in and why don't you hedge some of the volatile cash flows ahead of time and then plan on novating those to the securitization vehicle, post-closing. The price risk then is taken away. The securitization vehicle can add on hedges post-closing, but a lot of the near-term volatility is gone.
Excellent. So moving on to the next category, let's talk about basis risk. So Greg, you want to kick us off again? And I think this is an interesting one. I think the geography of where the assets are physically located is a big one here. Political overlay is a big one. So Greg, over to you.
Yeah, I think transactions that have multiple destinations for their product obviously allow you to be a little bit more versatile. Ones that are stuck up in certain areas, there's going to be blowouts. And the problem is with basis risk is there's not enough, the market's not deep enough or liquid enough to really handle, outside of say 2 years, maybe 4 years in some places. But the reality is the ones that are allowing you to go further out are the safer ones, and the ones that are allowing you to only go 2 years are the more volatile ones. So we attempt to apply a stress on top of the basis. I think we haven't done transactions where we believe the basis risk is unprotected or can't be protected at all. I think it can be mitigated, and it comes through on potentially higher credit enhancement through higher stresses. So that's how we attempt to do it. I would obviously like to see something more fully hedged on that basis, but similar to NGLs, it's so when we have deals that have a little more volatility on basis risk or more NGLs in it, there's just less depth in the market for hedging, and therefore you're going to see lower advance rates typically because we have higher stresses.
And Greg, from a mineral and royalty standpoint, you made the point earlier that it's more removed from the actual operations. When we've done these transactions in the past, if it's the operator carving out a non-op interest, you have more direct line of sight into their midstream arrangements. If it's a non-operator, obviously you're a little bit more removed, so much as long as the non-operator is not taking in kind. But how would you view it from a mineral owner standpoint, where the cash flows are really just royalties, and I would presume you're not going to have direct line of sight into the operator's contractual arrangements?
Yeah, I mean, a question becomes, and we definitely try to dig down one layer below, but as you said, for a non-op portfolio, we don't have access to them. We do have access to those particular fields through our corporate team. So it's not like we're blind. We just don't have the granularity information as it relates to their hedging practices, if you're talking about basis specifically. So I think we'd lean on, what basins are we in? How volatile is it? Because I don't know if you can effectively really hedge something if the operator themselves is hedging that, and then trying to lay a hedge on top of the deal. It could have conflicting kind of effects that might not be net positive. I don't believe. I think we'd struggle a little bit on that, and it would probably end up kind of looking at what's the diversification. And that's the good thing with royalties. Some of them are more diversified, but you do know the basins in which they're in, and you do know, the potential volatility there. I'd be interested to hear others on how you could potentially hedge that. I just don't know if it's that clean. It's definitely a dirty hedge because you just don't have control over it. And it would take a lot of manipulation to kind of protect against that and coordination. And I don't know if the non-op, or, well, certainly the royalty people don't, but the non-op people may not have that kind of visibility either. So I do think that's an issue.
So, Greg, I have a question for you. So we'll use Appalachia as an example. I think Appalachia is kind of at full capacity for, just in general from a midstream takeaway perspective. The FT contracts are all over the place. And, I've done a bunch of podcast episodes with minerals Appalachia players, a lot of the bigger ones that would possibly consider doing an ABS to have enough scale. They've been in the game up there for at least 8-9 years. From a title perspective, from a data perspective, that's what's required. And a lot of them have started to build FT contract proprietary data collections in-house. So they can know that a royalty in this unit is getting $1 less than MCF than a royalty in the unit just right beside it. And that just is stuff they've mapped out for minerals buying purposes. From a rating perspective, do you have to use publicly disclosed data or stuff that is in a commercially available product, or can you rely on someone's kind of in-house homegrown data?
We can, and we often do, rely on non-public information. I will have to say we triangulate / verify / dig in deep to see what the process is in which they understand that, and do they have real transparency and visibility, and is it effective, and has it been back tested? Those are questions we would ask anyone, and that, depending on someone who can manage that process, we certainly would give credit to that if we thought it was a credible process. In the long run, you're still going to be exposed to basis risk. Depending on the duration of the transaction, there's just no market for some of these. There's no depth to really get out further. So if someone proved to us that they had an effective process that could actually analyze that, it could help. It certainly would help in the short run. I'm not sure it fixes the problem in the longer run if it's a volatile market.
Sure. Okay, and the last one that's big is obviously price risk, and hedging is coming into this. So let's address hedging in this. But who wants to kick it off on how you guys have addressed price risk and how hedging expectations or requirements have evolved over time, over the last 3-4 years, and as more deals have happened?
Sure, I'll kick it off here. So what I tell all of our clients and prospects is think of hedging, kind of on bookends, right? The first pillar, or the first bookend, is what is the minimum that we have to have in place in terms of, tenor, so years, percentage of PDP, and by product, to get Fitch comfortable with assigning, investment grade rating, right? And then from that point, what is the advance rate, the loan amount that you're trying to get to, right? We've done plenty of analysis, especially on the NGL side, as Greg mentioned, because, the Fitch price deck for their stress cases, on NGLs are pretty punitive. So if you add an extra year of NGLs, you're getting a substantial uplift in loan amount, right? So depending on what you're targeting to get from loan proceeds and an advance rate, then we'll do an analysis on, how much to hedge it. I think the initial ABSs were pretty much fully hedged to tenor. We've seen some deals that had 10 years of gas hedged. We've done deals with 8 years of natural gas and 4 or 5 years of oil, of TI and NGLs per component. And those are those types of hedging structures will get you a higher advance rate, right? But some deals have been done in the market are closer to 3-4 years of 85% of all the products, right? So there's I think Fitch has done a really good job to not just broad brush say we need to be fully hedged at a minimum of 85% through tenor, right? And obviously the market and the liquidity is not there for a lot of these products, but also moving into what gets you covered and enough protection, right? Especially for unconventional assets, you're PV is heavy on the front end, so hedging less than, call it through the weighted average life of the note, should provide you substantial protection, right, to support an investment grade. And from there, if you want more loan proceeds, we'll add additional years after that. But Fitch will, they'll do the analysis and will tell us, right? It's, it's a very iterative process, I guess. Going back to your question, Tim, they'll do the analysis. We'll tell them, and a lot of these hedges are done before closing, right? So you're either novating, and you can novate out of the money hedges into the SPV, right? Because obviously a lot of operators already have hedges in place, right? So we can either novate a portion, all of it, into the SPV and then top off with current, strip futures. And then Fitch will run their analysis and will tell us, like, hey, we might need, this is what you would be looking at if, under this structure, and we can go back and add more hedges if needed.
Yeah, let me add a couple of things. And just to be clear, I mean, we have a criteria. And so all we do is analyze what we're given, and we give kind of we look at the model, and the banker will understand, the issuer will understand what the advance rate is. But the key variables that we look at, we're not, just because, TI is 110 or whatever it is, we're not changing our long-term stress, because our long-term stress is really based on more of a marginal cost curve of production. And so even if we're at $100, we haven't changed our long-term stress of 35 on WTI. Similarly for Henry Hub, we're not moving that around. Our corporate group, our price deck, people often ask this question, well, how come we're not using a corporate price deck? A corporate price deck that the corporate group would look at is a way to kind of do peer analysis. It's a way to kind of look at, how do the companies perform under the same price. And that's a living, breathing animal, a corporate is, and they can pivot and do different things. When you're doing a securitization, you're stuck with those specific assets, and you need to make sure, if you're not hedged, that you're using a very conservative price, because there's just no chance to get out. And so therefore we use our stresses are quite punitive. And the fact that there's no liquidity out in that market means there's no visibility, and that's kind of why we don't really want to take commodity risk. And the reason why this product works in a lot of ways is, and we'll get into the PUDs, I guess, but E&P, those are two different businesses, very different businesses, and price swings, will dictate where you're going to deploy capital, and therefore we don't get comfortable necessarily with undeveloped production. And I'm using that point because it's really, we're trying not to take commodity risk on these transactions. It's trying to be hedged as best you can to minimize some of that risk, because that's not really aligned with an ABS or a fixed income investor, where they get no upside, the equity guy's fine, but the debt guys are not getting any upside. So we're not giving upside, price benefits, because in the long run, the forward curve is not going to be out at that point. So anyway.
How have the deals in the last few years performed? I mean, we're looking at double the commodity prices, or is there a risk of being upside down in your hedges, or they've survived this kind of volatile price environment?
I mean, COVID was really interesting because there was production shut-ins, and basically people were making money off their hedges and not even producing oil. I mean, they're just shutting in, and the deals benefited from that. We saw a couple bankruptcies. They continued to pay, even during bankruptcy, say Chapter 11 type restructuring. The volumetric risk is not, there really hasn't been, everyone's outperformed in a lot of ways. Outside of the Texas freeze and then the, COVID, there's those periods of time in which you had dips, but we learned a lot back testing and looking at, how these have rebounded from where they were, and the type curve kind of has continued. You saw this big dip, and then they kind of got back online. So, we've been, all of our transactions have performed quite well. We wrote a couple pieces on that. There's not a lot of upside upgrade kind of, because oil commodity prices are not really helping the deals that much. There's some help on the unhedged portion, but it's not like, you're going to de-lever significantly, because the hedges are kind of aligned with the amortization of the duration.
And how
commenting about the way we decided to deal with hedging in the SLU ecosystem. When we started rating first super allocation, oil was actually negative for a while, and any hedging was actually not a possibility, of course. But so we decided to leave hedging completely outside of the securitization. So it is for investors and also ENPs and everybody which own working interests, which are actually securitized in the form of shares in LLCs, to decide the way they're going to be hedging their portfolio. And especially if you have traffic, Glencore, all these big trading firms, the hedging policy is an overall book which is global. They don't actually hedge instrument by instrument or property by property. So it's the reason why we believe in an ecosystem where trading and liquidity are daily. You cannot have hedging part of the securitization process itself. It's got to be at the discretion of the investor himself to decide the way that.
So let me ask you a question, because I'm hearing the word rating often, but these people are fixed income or equity type investors, just so I'm clear on that.
They're mainly equity.
Equity, yeah. Okay, so we're trying to analyze something in the lens of a long-term kind of institutional fixed income product. So I get your point 100% that an equity guy, he can either take that risk or not take that risk. But if we're putting a fixed income rating on something, then we have to kind of make sure that the transaction itself has the whole package. But I hear your point. That makes a lot of sense. I was just trying to make sure that
it's a good remark you're making, because working interest in terms of risks are probably more closer to equity than debt. Whereas maybe royalties would be closer to debt in terms of risk, because you don't have any capital call. So at the end of the day, you're right. These investors that are currently considering investing in these super allocation shares have got an equity profile.
And the other thing I'd add to that, though, because I think, non-working interest with pods and undeveloped acreage, that's kind of equity, and we don't have the visibility on capital deployment, and it's got commodity risk already attached to it. But PDP, non-working interest, has the profile for fixed income. I would think. Yep.
Yes.
Well, one last comment, guys. What about inflation? We had spoken, Patrick, and you had put the notion out of variable rates being introduced into the conversation. What are some of the ways that inflation has been addressed in this investment product?
Yeah, I mean, I think on the hedging and inflation, I think there's a couple different dynamics there where you have to look at. And I'm coming from the standpoint of a manager, an operator who's going to see if this makes sense from the equity standpoint. So when you look at the dynamic of rising rates, and you also look at the rising LOE, that's something that we, and Greg, it'd be interesting to hear how you guys look at that. But that's something that we've started, including in our underwriting process in the LOE side. It's just, hey, there's an inflation. You can see this in LOS, right? It's already pretty apparent. So you have to. I think on the rate, I think there's, I think as Tim and you and I were talking about, there's differing opinions here of short-term versus long-term. And I think, the notion of a variable rate that's being introduced was more of a, hey, look, on the short term, I think everyone sees the inflation. Long-term is a recession. And so that's, it's something we look at as like, does that kind of fit well for both sides of the equation here? Hey, look, right now I may be right that this needs to be higher, but longer term, you may be right that this rate needs to be lower. I think that inflation on the commodity price side, and this is something that, Greg is talking about how punitive some of their stress testing is. What you'll see is in higher price environments, it may make more sense to hedge longer dated, even though there's going to be higher credit charges there, because the spread between the current price and the stress price from Fitch is such a big spread. So, if you're paying an arm and a leg on the credit charge, you're still getting a better price, which means Fitch is not going to run it at that lower price. So there's some benefits to the inflation side of this that, obviously prices are up in the short term, but the rate and the LOE are something that have to be taken into account.
Okay, great. Well, let's. I want to jump to structuring. I want Raul to be able to jump in and share his expertise here. Let's talk about the legal structure and the ways these products are put together, SPV and kind of an umbrella and having different notes underneath that has been referenced a few times already. About a week ago, RISA did the first master trust securitization. I would love to be educated on exactly what that means. So Raul, over to you to talk about some of the main takeaways from the legal structuring side, and then we'll let the rest of the panelists jump in.
Yeah, I'll start at the most basic. And Greg hinted at this earlier when he talked about the real property treatment being important from the ratings agency side. It's very important to structure the transaction as a true sale. And so, putting aside the securitization element, the transaction documents are going to resemble any other working interest or mineral royalty purchase and sale agreement and conveyance. You're structuring the transaction as a true sale of real property from the sponsor to a newly created affiliate of the sponsor, an SPV. And then it's actually the SPV that will purchase these interests that will issue the notes. So two simultaneous transactions: one, purchase and sale of the interest to the SPV; second, an indenture note purchase from the SPV to the investors. The proceeds from the note sale then go through the SPV to the sponsor to serve as the purchase price for the interests that are going into the SPV. So what that does is it provides you with, if you do it right, true non-recourse debt at the SPV, backed by the assets that were purchased by the SPV. No recourse to the sponsor that ultimately monetized those assets via the transaction. What it also means is, because you're doing this as an oil and gas purchase and sale, you have to deal with everything you would in any other oil and gas A&D transaction, including things like consents, preferential rights that would burden the transfer of real property interests. And so, these are typically simultaneous sign and close transactions. So you aren't going to be able to sign up a transaction and get all your consents to transfer or waivers of your preferential rights before closing. And you're not going to want assets to get pulled out of the deal prior to closing either. So you can do a traditional sale and get all these consents that are necessary, or these pref right waivers. Or what we've been doing in some more recent transactions is if the sponsor is organized in Texas or is able to reorganize in Texas, Texas allows what they call a divisive merger, and basically allowing a company to undergo a quote unquote merger under Texas corporate law that results in two or more surviving entities. And you can do a plan of merger that results in a new SPV holding the assets that are going to back the securitization. It's a different type of transaction structure. It creates its own problems that needs to be solved. But what it does do generally is, if you have an asset base that is backed by a lot of transfer restrictions that may call into question whether you're able to include them in a sale, a merger generally will not implicate transfer restrictions, because under corporate law, a merger typically is not considered a quote unquote transfer. And so we've been successful utilizing a divisive merger to get the assets into the box that we need them to go into, and make sure that everything we want ends up being part of the securitization. And I will say, when we first started doing these, there wasn't a lot of familiarity with divisive mergers. I think there was a lot of discussion needed to be had with ratings agencies and with investors to make sure they got comfortable doing something that might have seemed exotic, and that they would still get the bankruptcy remote result that they wanted. Now, I think we're to the point where a lot of investors prefer the divisive merger, view it as a safer route, and a clean way to get the assets where you want them to go. So I expect to see that structure utilized more going forward.
Well, the most common question in the conversations I have with royalty players is scale. So I want to have, what is the right size for an ABS transaction? What is kind of the threshold or the bottom floor over time as, standardization is implied and there's more familiarity. But on the side of that question, in tandem, I want to ask you from a structuring standpoint, is there a way to do, quote unquote, mini ABSs under the same SPV umbrella and build up to that scale and re-rate? Or is there some workarounds there? Because some ideas very loosely have been thrown around about that. Do you have like a drop-down structure where you add royalties and overrides over time, and maybe it's not investment grade, but then you recap the debt and you make it an ABS? I'm throwing a lot of stuff out there, but this is where people are kind of at in their brainstorming. So would love to throw that to the panel and kill two birds with one stone here from a structural standpoint, but also scale, which is the number one question that comes out of the mineral space around ABS.
Yeah, I'm happy to start and say the issues with scale and the preference for larger size, I think really right now has more to do with there haven't been a lot of these transactions done yet. And so the transaction time and cost is higher. It hasn't been commoditized to the point where they get done very quickly. I think as more of these get done, the transaction timeline shrinks to be, about as long or shorter than an A&D transaction or an RBL transaction. You can do them at a smaller scale, just because the transaction cost itself is not as high for both the sponsor and the investors. I think investor appetite probably is for things that are chunkier, all things being equal. But commoditization of the product is probably the most important thing that can happen to kind of make it more of a solution for people at smaller scale.
And Ro, you said from a legal perspective, in terms of legal drag, royalties and overrides deals are simpler, easier to put together. And so when you look at throwing a number out there, 100 million in revenue for a royalties portfolio, that is substantial. That's kind of the quasi starting point to think about going public, whereas 100 million in a working interest property is not. So there's that bifurcation. But at the end of the day, if an investor is looking for yield in a fixed income type product through this, it doesn't really matter if it's royalties or working interest, as long as you can deliver the results. So, on that, maybe Victor, you want to jump in? Any others on how to solve for this scale issue? Is there ways to kind of build brick by brick or piece things together?
I mean, it's a very good question, Tim. And I think, we have gotten a lot of inbound calls for deals from 50 to 100 million, right? From overrides and royalty companies. And in my view, and I've had some discussions with Greg, it's not, size is not the issue, it's diversification, right? So when you think of a single operator, in an unconventional basin. If you have 100 million worth of PDP PV, your well count's going to be, in the, 30s, right? And that's not enough diversification from a well standpoint. But if you're dealing with royalties and overrides, you're probably spread out across hundreds, if not thousands, of wells, right? And that diversification you get just through the nature of the override and the royalty market, right? So I think that from our standpoint, really, if credit-wise you have the diversification and Fitch can get comfortable with the transaction, then the question becomes an economics question, right? It's like Rahul mentioned, we have kind of shortened the time frame as a lot. We've kind of standardized or lowered the cost, the transaction cost for these ABSs. But ultimately, we're almost to a point where it's almost, we have a clear sight on the fixed cost, if you will, of the transaction. So obviously, as a percentage of the total transaction, your transaction costs are going to be much higher on a smaller deal. But if you're getting a high advance rate and it makes sense for the company, fine, you'll be paying, X dollars, and that's going to be fixed, and it's going to look, a little bit higher than you would, ultimately want, right? Instead of 3% total transactions cost, you're looking at 5%. That's so long as you're comfortable with that, I think we can get a smaller deal done. And I'll pass it on to Greg in terms of, kind of credit considerations for smaller transactions. But from my viewpoint, we're happy to look at those transactions so long as they have enough diversification.
Everything you said about the diversification and size is how we look at things. Well, we don't think about size. It becomes a diversification question. That is really all we're looking for. So I think you can achieve that on these royalty and non-op deals potentially. Yeah. The only other thing I would add is this really is in my area, so I'll probably just pass on the comment. But economics in general, I think, are the question. And liquidity, a $50 million deal for an investor, it's just, they need to amortize their brain power. Mm-hmm. So there's just a higher coupon necessary to kind of deal with that. It's not just the fixed costs with bankers and lawyers and everything else. Investors need to amortize that, and it becomes a little inefficient if you're in that area. So
yeah, I think Rahul hit that point on the financial and legal side of things, just to make it more commoditized. I think the same thing on the investor side, right? So a lot of the players in these deals have wanted to have bigger check sizes. As this expands and becomes a bigger product, they'll find more and more entrants that are happy at 10 million rather than 50, and so they'll be happy to take a slug of a smaller deal.
Great. Well, guys, if you don't mind, I'm going to run like 5 minutes over. We'll try to fit in some final questions. Stefan, over to you. To date, PUDs have not been securitized. It's tricky. You've been working on it for 3-4 years, and you've had input from Baker Botts, Ryder Scott, Grant Thornton, a lot of stakeholders on the operating side. Walk through the structure, kind of going back to the question around structure, the structure of the SLU investment product and how you've gone about mitigating some of the risks that are around, undeveloped in a way that makes it investable for someone, pensions, European institutions, insurance, etc.
Yes, when I was listening to people talk, folks here talking about structuring, what we've tried to structure is actually ESG as an asset. So that's a new concept. Can ESG be an asset? Well, you have two new marketplaces which are considered to be where ESG assets are going to be trading. Like one of them is Expansive, created and launched together with Standard & Poor's. So we've tried to structure ESG, and it's because lots of investors in Europe are actually bound by the SFDR decision tree, and question Article 9 is investment sustainable? If it's not, they cannot invest. So oil and gas, they cannot, but it's possible to make oil and gas investable by making sure you have carbon credits, you've got an ESG framework, and this is what we've done. So the structuring of the SLU marketplace is reporting of venting and pre-production venting and flaring is going to be accurate. And right now, this is the biggest issue for these companies. These investment companies cannot invest in any project because they know the reporting of venting is not ring-fenced, it's not compulsory, it's not blockchain. So this is the way we've structured a superlocation. Is actually operated by a major, by an independent, but it's a showcase for this independent to demonstrate that within a very stringent reporting framework, they don't vent at all. And this is what is very interesting for investors. So we've securitized very small properties called superlocations, which are basically 1280 properties. The working interest are swapped into shares in LLC. There's a binding development plan with binding development dates and a rating by Riders Court. And there's an ESG endorsement because the reporting of everything linked to ESG is compulsory, is not made by the operating company, but by the framework itself, by the marketplace, which is regulated by the SEC. So this is a framework which is so impressive for investors like large pension fund in the UK, that this pension fund has taken a stake in this SLE enterprise because they want to be able to invest in oil and gas in this very safe ESG environment. And what's very interesting is that we're going to see a price discovery on how much of a premium should an asset which is operated in a full ESG way, as opposed to an asset which is actually still venting, still flaring, and doesn't report about that. It's what we call an ESG premium, and we believe this is an asset. So in fact, we are securitizing ESG as an alignment. It's an asset.
And on that point, secondary market liquidity on these types of investment products. Patrick, you want to jump in? Stefan, take over back to you as well to comment on that.
Yeah, I mean, I think it's developing. I don't know if it's there yet. I don't know. There's been any secondary transactions on the equity side, at least. I'm not unsure on the senior side. But I think that as you look at the maturity of this product and how it kind of casts a wider net of who it makes sense for, obviously right now it's more of a recap tool. It's more of a debt financing tool, cheaper cost of capital, maybe better terms than an RBL. I think as we look at how it expands to someone using it for more of an exit, so maybe that's a PE-backed company that eventually wants to get to an exit. As it stands today, this is maybe creating more illiquid asset just because the unwind cost of a hedge and no call provisions on seniors, that could cause problems for liquidity of the equity down the road. I think you're looking at this becoming more of a more established product. Have a track record, have proof of concept. Those entities can start using this to say, hey, there's a secondary market of this. I can securitize this and I can eventually sell off the equity of this to the group of investors that want that profile, want the production only, type investment. And so that's something that, we've looked at. That a lot of these are kind of credit hedge funds that like that type of risk, that are active in origination of this, but are also active in, looking at secondary market of the equity.
Yeah, that was one of the questions from the audience is, could you do securitization through an ABS in parallel to looking at an outright equity sale or an IPO, or does it really, in your words, make it more illiquid? And I think the development of the secondary market is going to be important for bringing more sponsors in, I guess. Would you say?
Yeah, I think it's right. I mean, I do think there's an appetite for that. There's a trade-off. We've talked a lot of the dynamics of the senior. You just have to understand that you can't bite off your nose, spite your face on optimizing senior and not have value for the equity, right? So, having upfront yield, you can maximize your senior debt and have all the cash flows go to amortize the senior. Well, you might push out some of the equity investors in that, right? So I think there is a balance. I think that's something we've talked to a lot of different sellers who have said, hey, I have an exit coming up that I want to get to. Can securitization make sense? We've looked at, partnering with, our investors on that, saying, hey, here's the framework we need for our equity investors. You can go do the securitization. We can buy into the equity and we can syndicate out the rest of the equity over time. And you eventually can exit this, but it needs to be structured to fit for the equity as well.
Okay, great.
And there is another point we haven't mentioned at all, Tim. It's about the optionality in the balance sheet of all the NPs. Like if you look at large NPs, some have 50 years of reserves. They have so much optionality there that is not monetized. This is something that is very interesting to securitize as well, because there's a lot of value there. The day we put together a superlocation with a binding development date, it becomes an option on future development. And that can be also an asset that can be securitized. So plenty of assets that can be securitized in the oil and gas world right now. And this is a very interesting discussion.
Phenomenal. One last question. I know we're a little late, guys, but I want to touch on it. And that's let's put ourselves in the shoes of the investor here for a moment. What kind of optionality do you have in terms of, we'll look at duration as one. I was doing a little reading on the Pure West energy deal that happened end of last year. And there was actually an A1 note and A2 note. And one was for kind of shorter term investment horizon, and the second was longer term. And I'm sure the coupon rate was different on that. But Raul, have you seen nuances in the way, the types of investors that are coming in and how the notes are put together, or is it kind of cookie cutter at this point? Because what's worked in the first few, you kind of have to replicate that, and over time, as it gets mature, you can start to make it a more nuanced product.
From what I've seen, it's usually started with what advance rate do you want? What are you trying to solve for? What are you trying to get to? And then where's the rating agency coming out on what I would call your top tranche of notes, and it really follows from that. If you're not getting the advance rate that you want, are you able to do a sub-investment grade tranche? Is there a buyer for that tranche that can get you to the cash proceeds that you're looking for? Victor, I don't know if you've seen additional nuance there.
Yeah, no, I think that's a good way to summarize it. I mean, we've mostly done single tranches. Pure West was a dual tranche. But if I'm not mistaken, obviously we didn't advise on that one, but if I'm not mistaken, they kind of cut it down the middle in terms of like 30% advance rate for the shorter tenor, and then 30% advance rate to kind of get close to a 60% advance rate with a longer tenor. And I don't know if that one was the one that had 144A on it, right? Most of the ones that we've done are 4A2 format, pretty much all of them except for one. Once you start tranching, I think, and other industries do it, it is to maximize advance rate. Now, if you have the investor lined up that doesn't need an investment grade, and you're willing to obviously pay a much higher coupon for a sub-investment grade tranche, you can go that route, right? Ultimately, adding even a sub-tranche possibility and going to debt funds that would take that piece, right, above and beyond, the ABS. So I think it's an option if you're trying to maximize advance rate. It's costly, and I think it adds some complexities to the transaction. Based on what I'm seeing, 4A2 market is deep enough to take any size right now up to north of $500-600 million. So there's, I don't see the full need of that unless you're trying to maximize advance rate on a single transaction.
Okay, great. Well, guys, we have a lot of questions. We're just not going to get to them. We're already running late. I just want to say thank you to all y'all on the panel for joining and contributing your time and expertise. Thank you to everyone who registered. This will be made in the form of a podcast on the Minerals and Royalties podcast. If you want to check it out after, we're also on the Minerals and Royalties Authority YouTube channel, have the full video version of the webinar available. So thank you, everyone. Sorry we didn't get to answer all the questions. Tried to touch on all the different parts of it, but really, really enjoyed it. I hope there's a lot of value derived from this. And please reach out to anyone on the panel for follow-up if you see relevance there. Have a great day, everyone, and appreciate your time.